It's the afternoon of January 16th, 2026, and your screen is lying to you. Right now, the mainstream ticker is bleeding red. Silver just got absolutely crushed, down over 3% in a single session. Gold is sliding. The talking heads are calling this the end of the metals mania, the moment the commodity supercycle hit a brick wall. And if you're watching CNBC or scrolling through the usual financial channels, you'd think the party's over. But here's what they're not telling you. While silver is experiencing this violent emotional flush, while the retail crowd is panic selling their positions and the fear merchants are screaming about the great metals crash, there's one metal sitting there with the kind of stability that makes my hair stand up. Copper, $5.86 per pound, holding the line like it's welded to the floor. Now, I've been analyzing commodities markets for 12 years, and I built this channel specifically to cut through the noise faster than the mainstream can spin it. I'm not here to feed you hype. I'm here because I saw something this afternoon that I couldn't wait 12 hours for some talking head to finally report. While everyone is watching the exit sign, I'm watching the VIP entrance. And what I saw is this. Amazon Web Services, AWS, just bypassed the entire public market to secure copper directly from the source. A 2-year direct offtake deal with Rio Tinto, not through the LME, not through COMEX, direct. Samsung's doing the same thing. These aren't speculative trades. These are strategic acquisitions of a resource that the world's largest tech companies have decided they cannot afford to be without. So let me ask you something. If copper is just another industrial commodity that is about to crash with everything else, why are the biggest corporations on the planet locking in multi-year supply contracts right now? Why are they willing to pay above market rates to guarantee delivery? The screen is telling you one story. The shadow market is telling you another. And if you think what's happening with silver today is the real story, you're about to miss the tectonic shift that's been building beneath the surface for the last 175 years. Because what we're witnessing right now isn't just a market rotation, it's the moment copper stops being treated as a commodity and starts being treated as the strategic asset it actually is, the new gold. And the institutions are front-running the public before most people even realize there's a shortage coming. Thesis plus promise. Here's my primary claim, and I need you to understand this clearly because everything else in this breakdown builds from here. Copper is no longer a commodity. It is becoming a strategic tech asset that Amazon, Samsung, and every other major player in the AI and electrification space are securing before the public markets even wake up to the structural shortage. This is not about short-term price action. This is not about riding some hype wave. This is about recognizing a fundamental shift in how the world's most critical infrastructure metal is being valued and allocated. We are witnessing what I call the great decoupling. Silver and gold are being treated as fear trades, insurance policies you buy when you're scared the system is breaking. And don't get me wrong, I stack physical silver. I understand the appeal. I've been in that world for over a decade. But copper? Copper is being treated as infrastructure oxygen. It's the metal you need if you're building the future. AI data centers, electric vehicle fleets, renewable energy grids, high-speed rail. Every single piece of technology that's supposed to power the next 20 years of human civilization requires massive amounts of copper. And here's the uncomfortable truth that the mainstream financial media does not want to talk about. Supply cannot respond to this demand for at least a decade. Not because of some temporary bottleneck, not because of a logistics hiccup, but because of the fundamental physics of mining. It takes 12 to 15 years to bring a new copper mine online from discovery to production. Ore grades have dropped 30% since the year 2000. The easy copper has already been pulled out of the ground. And meanwhile, demand is accelerating at a pace that would have seemed insane just 5 years ago. So in this breakdown, here's what I'm going to do. First, I'm going to walk you through the exact market structure we're seeing right now, the specific price action, the inventory data, the institutional positioning, the stuff that's happening in real time while the mainstream is still writing yesterday's headlines. Second, I'm going to break down the macro rotation mechanism. This is the copper to gold ratio, and it is the single most important signal for understanding when the market is shifting from defense to offense, from fear to growth, from precious metals to industrial tech metals. Third, I'm going to run the math, not the hopium math, not the hype math. The actual supply-demand numbers that show you why $5 per pound is on some bubble top. It is the new floor for a world that has no choice but to electrify. Fourth, I'm going to steelman the strongest argument against this thesis. Because if I can't defend against the best counter-argument, then I have no business making this case. And finally, I'm going to share my personal battle plan. Not advice, not recommendations. Just the exact triggers I'm watching and how I'm positioning myself as this unfolds. This isn't a trade for tomorrow. This is a cycle signal that has been building for 175 years, and it's about to break into the public consciousness in a way that is going to catch most people completely off guard. The promise is this. By the end of this breakdown, you will understand why the real story isn't the red flush you're seeing on your screen today. It's the shadow withdrawals happening at the London Metal Exchange that nobody's talking about. Let's get into it. On the ground reality. All right, so let me give you the snapshot of what I was looking at a few hours ago. January 16th, early afternoon, Eastern Standard Time. Gold, 45, 88 and 12 cents, down $21.84 on the day. Silver, 88.55. A brutal minus 3.15% dump. This is the kind of move that makes retail traders question everything they thought they knew. Copper, $5.86 per pound. Now here's what's critical about that copper price. While precious metals are getting absolutely hammered, while the headlines are screaming about the end of the commodity supercycle, copper is holding firm, not rallying, not mooning, just holding. And in a market like this, that stability is more telling than any moonshot. Let me explain what I mean by that. When you look at the CFD structure for copper, you're seeing a high liquidity battle zone at 586. Despite the panic dump in precious metals, despite the broader risk-off sentiment, despite every reason for copper to be selling off in sympathy, it's refusing to surrender the 550 to 580 structural support level. This is what I call tectonic stability. It's not flashy, it's not exciting, but it's the kind of price action that tells you there are very large hands underneath this market who are not willing to let it break lower. Now contrast this with what's happening in silver. Silver is experiencing what the market calls a red flush. It's emotional, it's volatile, it's driven by paper traders who are selling out of fear, who are responding to headlines, who are trying to front run what they think is a broader metals crash. And I get it. I understand why retail is nervous. When you see a 3% down day in silver, your first instinct is to ask, is this the beginning of a bigger collapse? But here's where the paper market and the physical market are telling you two completely different stories. While paper traders are dumping silver contracts, physical giants like AWS are signing 2-year direct offtake deals with Rio Tinto for copper. Think about that for a second. Amazon Web Services isn't speculating. They're not trying to flip a commodity for a quick profit. They are securing multi-year supply contracts because they have done the math on how much copper they need to build and maintain the data center infrastructure that powers their entire business model. And they are willing to bypass the public markets entirely to guarantee that supply. This isn't unusual behavior during a commodity boom. This is unusual behavior during what the mainstream is calling a commodity crash. So you have to ask yourself, what do they know that the paper markets don't? The silver flush on your screen is real, the volatility is real, the fear is real, but the shadow withdrawals happening at the LME, those are real too. And the institutions are telling you to sell the metals crash, while they are quietly hardwiring their data centers with the very thing you're being told to ignore. I have been watching commodity markets long enough to know that when there is a disconnect this large between what the screen is showing and what the physical market is doing, you need to pay attention to the physical market. Because the screen can lie, sentiment can shift, paper can be printed, but you can't print copper mines. The teaching block, macro rotation. Now I need to slow down here because this next part is the foundation for understanding why this matters. We're going to talk about the copper to gold ratio. And I know, ratios sound boring. They sound like something you'd see in a textbook that puts you to sleep. But this ratio is the economic seesaw. And right now, that seesaw is tilting in a direction that most people aren't prepared for. Let me break this down. The copper to gold ratio measures the market's preference between two fundamentally different types of assets. On one side, you have gold, the ultimate defensive asset, the emergency fund, the insurance policy. On the other side, you have copper, the industrial workhorse, the infrastructure metal, the thing you need when you're building the future. Think of it like this. Gold is what you buy when you're scared. When you think the system is breaking, when you don't trust currencies, when you want to preserve wealth in a form that has held value for 5,000 years. Copper is what you buy when you're building. When you're laying electrical grids, when you're manufacturing EVs, when you're constructing data centers and renewable energy infrastructure, you buy insurance when you're scared. You buy wiring when you're building the future. So the ratio between these two metals tells you something profound about where the market thinks we are in the economic cycle. When the copper to gold ratio is falling, it means the market is rotating into defense. People are scared. They're buying gold. They're selling industrial metals. This typically happens during recessions, financial crises, periods of extreme uncertainty. When the copper to gold ratio is rising, it means the market is rotating into offense. People are building. They're investing in infrastructure. They're betting on growth. And here's the trap that most precious metals holders are walking into right now. They've been conditioned to see gold and silver as the ultimate safe havens. And in many scenarios, they are. I'm not disputing that. But when the ratio starts to turn higher, when copper starts to outperform gold, it signals a shift towards cyclical industrial utility assets. And if you're holding only defensive assets during that shift, you're positioned for the last war, not the next one. Now let me show you where we are right now. Stop. Look at this from a technical perspective. The copper to gold ratio just completed what Elliott wave theorists would call an ABC flat correction. For those who don't speak technical analysis, that basically means the market spent months digesting previous gains, consolidating, building a base. And that correction? It just ended. The seesaw is tilting. Now, I'm not saying gold is going to collapse. I'm not saying silver is dead. What I'm saying is that the market is starting to favor the metal that represents growth and infrastructure over the metals that represent fear and preservation. And this shift doesn't happen overnight. This is a slow, grinding rotation that can take months or even years to fully play out. But the early movers, the institutions, the tech giants, the companies that are building the infrastructure of the next decade, they're not waiting for CNBC to confirm the trend. They're positioning now. Here's why this matters for you. If you're a precious metals holder and you're only watching gold and silver, you're missing the bigger picture. The market is trying to tell you something. It's saying the era of pure defense is giving way to the era of strategic offense, and copper is the tip of that spear. Let me give you the analogy that finally made this click for me years ago when I was trying to understand commodity cycles. Imagine you're in a war. In the early stages, when you don't know if you're going to survive, when chaos is everywhere, you stockpile ammunition, you dig bunkers, you focus purely on defense. That's gold, that's silver, that's the fear trade. But at some point, if you're going to win the war, you have to go on offense. You have to build supply lines. You have to manufacture tanks and airplanes, and all the industrial capacity you need to actually project power. That's copper. That's the growth trade. And what the copper to gold ratio is telling us right now is that the market is starting to shift from bunker mentality to build mentality. Now here's the pattern. Interrupt, I need you to see. This isn't just theory. This isn't just some abstract macro concept. Look at the AWS deal. Look at Samsung. Look at the fact that LME inventories have been quietly declining while corporate offtake agreements are accelerating. The rotation isn't coming. It's already here. The institutions just haven't announced it on the ticker yet. The math. All right, now we need to run the numbers. Because if I can't show you the math, then this is just another hot take in a sea of financial noise. Let's start with the demand side, and specifically the EV and grid gap. A traditional internal combustion engine vehicle uses about 20 kilograms of copper. That's your wiring, your starter motor, your alternator, basic stuff. An electric vehicle uses approximately 80 kilograms of copper. That's 4 times the copper intensity per vehicle. And we're not talking about a marginal shift in the auto industry. We're talking about every major automaker on the planet committing to full EV lineups within the next 10 to 15 years. Now take that and multiply it across global auto production. We're looking at roughly 80 million vehicles produced per year globally. If even half of those transition to EVs over the next decade, you're talking about an additional 2.4 million metric tons of copper demand just from the automotive sector alone. But it doesn't stop there. AI data centers are the new wild card that nobody was pricing in 5 years ago. A single large-scale data center can require anywhere from 5,000 to 10,000 metric tons of copper for cooling systems, electrical distribution, backup power, and high-speed interconnects. And we're not building 1 or 2 of these. We're building hundreds. Microsoft, Google, Amazon, Meta, they're all in an arms race to build AI infrastructure. And every single watt of computing power they add requires copper to keep the system from melting down. Then you have renewable energy grids, solar farms, wind installations, grid-scale battery storage. All of it is massively copper intensive. A single offshore wind turbine uses approximately 8 metric tons of copper. A solar farm uses about 5.5 metric tons per megawatt of capacity. The International Energy Agency has projected that to meet global climate goals, we need to triple renewable energy capacity by 2030. That's not an optimistic forecast. That's the bare minimum to stay on track. So when you add up EVs, AI data centers, renewable grids, and baseline industrial demand, you're looking at a multi-decade locked-in demand profile that hasn't existed in human history. This isn't cyclical demand that goes away when the economy slows down. This is structural demand that's baked into the infrastructure requirements of modern civilization. Now let's talk about the supply side, because this is where it gets uncomfortable. New copper mines take 12 to 15 years to come online from discovery to production. That's not an exaggeration. That's the average timeline when you account for exploration, permitting, environmental reviews, financing, construction, and ramp up. And here's the kicker. Ore grades have dropped 30% since the year 2000. What that means in plain English is that mining companies have to move 30% more rock to extract the same amount of copper. The easy, high-grade deposits have already been mined. What's left is deeper, lower grade, and more expensive to extract. So not only does it take longer to bring new supply online, but each ton of new supply is more capital-intensive and energy-intensive to produce. Now, let me run a simple stress test for you. Let's assume global copper demand grows by just 3% per year. That's actually on the conservative side, given the electrification trends we just discussed, but let's use it as a baseline. 3% annual growth on current demand of roughly 25 million metric tons per year means we need an additional 750,000 metric tons of new supply every single year just to keep pace. But here's the problem. There aren't enough new mines in the development pipeline to meet that growth. According to the most recent data from S&P Global, the copper industry is facing a cumulative supply deficit of nearly 10 million metric tons by 2030 if current trends continue. 10 million metric tons. That's not a rounding error. That's a structural gap that cannot be bridged by incremental efficiency improvements or recycling alone. And speaking of recycling, let's kill that myth right now. Yes, copper is highly recyclable. About 30% of global copper supply comes from recycled material. But here's what the recycling optimists always leave out. Recycled copper cannot meet the high purity standards required for advanced applications like AI high-speed cooling systems and next-generation EV circuitry. You can't just melt down old pipes and wiring and turn them into semiconductor-grade copper. The metallurgy doesn't work that way. You need virgin material for the most demanding applications. So, while recycling will continue to play a role in meeting baseline demand, it cannot fill the gap for the high-tech, high-purity applications that are driving the next wave of demand growth. Now here's where the math gets really interesting. If you run a discounted cash flow model on copper miners based on a long-term price of $5 per pound, you'd think the market is pricing in plenty of upside, right? But here's the thing. $5 per pound isn't hype. It's the new floor for a world that requires electrification to survive. When you factor in the cost inflation for mining equipment, energy, labor, and regulatory compliance, the all-in sustaining cost for many copper producers is already approaching $4 per pound. That means at $5, you're only looking at a $1 margin. That's not the kind of margin that incentivizes massive capital investment in new projects. For the industry to justify building the mines, we need to close the supply gap. Copper prices need to be sustainably above $6 or $7 per pound. And the market hasn't priced that in yet, so the numbers don't match the current paper price. We're looking at what I call a tectonic grind, not a tsunami. This isn't going to be a dramatic moonshot that happens over a few weeks. This is a slow, grinding revaluation as the market wakes up to the fact that the physical metal is disappearing into long-term corporate supply chains faster than new supply can replace it. And here's the final piece of math that should keep you up at night. If the math is this clear, if the supply deficit is this obvious, why isn't the price at $10 per pound yet? Because of the enemy we're about to discuss in the next section. Skeptics, steelmen. All right, let me pause here and do something that I think is critical. I need to steelman the strongest argument against this thesis, because if I can't defend against the best counter-argument, then I'm just another talking head pumping hopium. So let's recap where we are so far. We've established that AWS and Samsung are signing direct offtake deals for copper, bypassing public markets. We've seen that copper is holding 586 support while precious metals are getting crushed. We've broken down the copper to gold ratio and the macro rotation from defense to offense. And we've run the math on the structural supply deficit. Now here's the strongest case against this whole thesis. Recession will kill demand. And I'm not talking about some shallow 6-month slowdown. I'm talking about a prolonged global manufacturing recession where the PMI, Purchasing Managers Index, stays below 50 for an extended period. If that happens, the argument goes, copper's so-called supercycle is just a debt-driven mirage. All this talk about EVs and AI data centers and renewable grids assumes continued economic growth and massive capital investment. But if credit conditions tighten, if corporate balance sheets come under stress, if governments pull back on green infrastructure spending, then all that projected demand evaporates. In copper, being a cyclical industrial metal would get crushed. This is the bear case, and it's not a straw man. It's a legitimate concern. So let me address it directly. First, let's acknowledge that, yes, copper is cyclical. In a severe recession, demand would absolutely take a hit. I'm not going to pretend otherwise. But here's where the traditional cyclical playbook breaks down. The direct corporate deals prove that tech giants don't care about the PMI. They care about availability. Think about what AWS is doing. They're not speculating on copper prices. They're not trying to time the cycle. They're de-risking their supply chains because they know that if they wait for prices to crash and then try to secure supply, the supply might not be there. This is the key insight that separates this cycle from previous commodity booms. In past cycles, demand was fungible. If the economy slowed down, you could defer projects, delay construction, wait for better conditions. But the infrastructure demands driving copper today are not fungible. They're not optional. If you're Amazon and you need to build a data center to support your AI services, you can't just delay that project indefinitely. Your competitors are building. You're either securing the copper you need now, or you're falling behind in the AI race. If you're an automaker and you've committed to transitioning your entire fleet to EVs by 2035, you can't just pause that transition because the economy hit a rough patch. You're locked into massive capital investments, retooling factories, training workers, signing supply agreements. This is what I mean by locked-in demand. Now, could a deep recession slow the pace of that transition? Sure. Could it delay some projects? Absolutely. But it can't eliminate the structural need for electrification. The world has made a collective decision, driven by climate policy, technological advancement, and energy security concerns, that the future is electric, and that future requires copper. So even in a recessionary scenario, you're looking at a temporary demand slowdown, not a structural demand collapse. And here's the critical point. Supply can't respond quickly, even if demand does slow down. If we enter a recession and copper prices soften, what happens? Mining companies cut back on exploration. They delay new projects. They focus on maintaining existing operations rather than expanding capacity. And when the economy recovers, which it eventually will, the supply deficit is even worse than before. This is the supply trap that most people don't appreciate. Unlike manufacturing, where you can idle a factory and then bring it back online in a few months, you can't idle a mine development project and then restart it quickly. Once you pause a major mining project, you're adding years to the timeline. So the recession argument, while valid in terms of near-term price volatility, actually reinforces the long-term structural case for higher copper prices. Now let's address the second major skeptic argument. Recycling will save us. This is the one I hear all the time. Oh, copper is infinitely recyclable. As prices rise, more recycling will come online and fill the supply gap. And on the surface, it sounds reasonable. But here's the metallurgical reality that the recycling optimists ignore. Recycled copper cannot meet the high purity standards required for the most demanding applications. I mentioned this earlier, but it's worth repeating because this is the fatal flaw in the recycling argument. When you recycle copper from old wiring, pipes, and industrial scrap, you get copper that's good enough for general construction and basic electrical applications. But AI data centers require ultra-high purity copper for cooling systems and high-speed interconnects. Next-generation EV motors and battery systems require copper with extremely low levels of impurities to maximize efficiency. You can't just take recycled copper and use it for these applications without extensive re-refining, which is energy-intensive and expensive. So yes, recycling will continue to meet a portion of overall copper demand. But it cannot fill the gap for the high-tech, high-growth sectors that are driving the structural demand increase. The third skeptic argument is about China. China's economy is slowing. China is the world's largest copper consumer. If China goes into a prolonged slowdown, copper demand collapses. Again, this is a legitimate concern. China accounts for roughly 50% of global copper consumption. Any significant slowdown in Chinese industrial activity would absolutely impact global copper demand. But here's what that argument misses. China is also the world's largest investor in renewable energy and EV infrastructure. Even as their property sector struggles, they're massively ramping up solar, wind, and grid-scale battery installations. So while traditional industrial demand from Chinese construction might soften, the electrification demand is accelerating. And beyond China, you have India, Southeast Asia, and parts of Latin America that are in the early stages of their own infrastructure build-outs. The geographic distribution of copper demand is shifting. It's becoming less concentrated in China and more distributed globally. So a Chinese slowdown would hurt, no question. But it wouldn't eliminate the global structural demand story. All right, so having steelmanned the bear case, here's my conclusion. The recession argument is valid for short-term volatility. If we hit a severe downturn, copper prices could absolutely pull back. But the structural supply deficit is real. The locked-in demand from electrification is real. And the inability of supply to respond quickly is real. So if you're thinking in terms of weeks or months, sure, there's recession risk. But if you're thinking in terms of years, if you're trying to position for the structural megatrend, the bear case does not hold up. Because at the end of the day, you can't print copper mines. What happens next? So now that we've laid out the thesis, run the math, and addressed the strongest counterarguments, let's talk about what happens next. Because this isn't just an academic exercise. This is about reading the market in real time and understanding the moves that are happening beneath the surface. First, let's talk about the institutional reaction. I'm watching the LME and COMEX closely for any changes to margin requirements. And here's why that matters. When physical inventories start declining and volatility increases, exchanges typically respond by raising margin requirements for futures contracts. This is a risk management tool, but it also has the effect of squeezing out speculative leverage. If we start seeing margin requirement increases at the same time that shadow withdrawals are accelerating, that's a signal that the paper market is coming under stress. And when the paper market comes under stress, that's when price discovery starts breaking down. Now, what do I mean by shadow withdrawals? The LME reports inventory levels, but those numbers only tell you what's sitting in registered warehouses. They don't tell you about the copper that's being pulled into private corporate stockpiles through direct offtake agreements. The AWS deal, that copper isn't going to show up on the LME. The Samsung deal, not on the exchange. So you can have a scenario where official inventories look stable or even slightly elevated, while the actual available supply for spot transactions is evaporating. This is what I call moving into a dark inventory phase. The most important metal on Earth won't even be available on the public markets because it's already been allocated to long-term corporate contracts. And if that sounds far-fetched, go look at what happened in the lithium market over the last few years. Major auto manufacturers signed multi-year direct supply agreements with miners, bypassing the spot market entirely. Copper is heading in the same direction. Now let's talk about the media narrative, because this is where things get interesting from a behavioral psychology standpoint. Expect the financial media to stay laser focused on silver's volatility. Why? Because volatility generates clicks. Fear generates engagement. A 3% down day in silver is a headline. A steady grind higher in copper over 6 months? That's not a headline. The mainstream media isn't trying to mislead you. They're just optimizing for attention. And attention is drawn to volatility, not to slow structural shifts. So the narrative will be about the metals crash, the end of the commodity supercycle, the retail traders who got caught in the precious metals hype. And while everyone is focused on that narrative, the institutions will continue quietly securing copper supply through off-exchange deals. This is the classic misdirection play. Keep the retail crowd focused on the shiny, volatile thing while the real move happens in the slow, boring thing that nobody's watching. Now, here's the dashboard I'm personally monitoring to track how this unfolds. Number 1, LME inventory levels. If these continue to drop while corporate direct offtake deals are rising, that's confirmation that the squeeze is moving off exchange. I'm not looking for a dramatic crash in inventories. I'm looking for a steady, grinding decline that persists even when prices are flat or slightly lower. That would tell me that price isn't the clearing mechanism anymore. Availability is. Number 2, the 550 floor. If copper holds above $5.50 per pound during the next broad market sell-off or risk-off event, that's confirmation that the decoupling is permanent. It would mean that copper is no longer trading as a pure, cyclical industrial commodity. It's trading as a strategic tech asset with a structural bid underneath it. Number 3, the spread between futures and physical premiums. If you start seeing physical premiums widen significantly above futures prices, that's a signal that the spot market is tighter than the paper market is pricing in. This is what happened in the early stages of the oil super spike in the 2000s. Futures markets were still pricing in modest growth, while physical barrels were trading at significant premiums because actual supply was constrained. Now, I want to be clear about something. None of this is going to happen overnight. This isn't a GameStop-style short squeeze that explodes in a week. This is a multi-year structural trend that grinds higher in a way that most people won't even notice until it has already happened. The price could chop around between $5 and $6 for months. It could even pull back to $4.50 if we get a sharp recession scare. But the underlying fundamentals, the supply deficit, the corporate positioning, the locked-in demand, those don't change based on short-term volatility. And here's what I think is the most likely scenario for the next 12 to 18 months. We're going to see continued volatility in the precious metals complex. Gold and silver will have big up days and big down days. The retail crowd will get whipsawed. The talking heads will keep calling tops and bottoms. Meanwhile, copper will grind. It'll hold support. It'll have occasional spikes on supply disruption news. But mostly, it'll just not go down. And slowly, quietly, the corporate supply chain managers will keep locking in long-term contracts. The LME inventories will keep declining. The mining companies will keep reporting that new projects are delayed or over budget. And at some point, maybe late 2026, maybe early 2027, the market will wake up to the fact that there's a structural shortage. And that's when the real move happens. Not because of speculation, not because of a short squeeze, but because the physical market has already been cornered by the institutions. And the price has to adjust to reflect the new reality. That's the playbook I'm watching. My personal battle plan. All right, so now I need to be very clear about what I'm doing personally with this information. This is not advice. This is not a recommendation. This is just me sharing my own line in the sand, my own triggers, my own plan for how I'm navigating this setup. Here's my perspective. I'm watching the copper to gold ratio daily. If it continues to turn higher while silver is being suppressed or range-bound, I am personally rotating my focus from precious metals to industrial tech metals.